$735. That is the average monthly car payment in the United States as of 2026, according to Experian's State of the Automotive Finance Market report. $735 every single month for a depreciating asset that is losing value every hour it sits in your driveway. Here is what that same $735 per month looks like if you invested instead. At an average 10% annual return, the S&P 500 historical average over 30 years, $1,216,000. Over $1.2 million. From one car payment. That is not a rounding error. That is the actual output of a standard compound interest calculation. And I want to be clear, I am not saying never own a car. Cars are necessary for most Americans. I am saying the way most people buy cars is one of the most financially destructive habits in modern life, and it is designed to be. Let's start with depreciation, because it is the foundation of everything wrong with new car ownership. A new car loses approximately 15 to 20% of its value the moment you drive it off the lot. This is not an exaggeration or a myth. It is confirmed by IC Cars and Kelley Blue Book research year after year. By the end of year 1, down 20%. By the end of year 2, down roughly 30%. By the end of year 3, down 40%. By the end of year 5, down 50 to 60%. You buy a $45,000 car, which is right around the average new vehicle transaction price in 2026. 5 years later, it is worth approximately $18,000 to $22,000. You have absorbed $23,000 to $27,000 in depreciation losses. That is money that is simply gone. It does not come back. It is not tax deductible in most cases. It is the financial equivalent of setting $5,000 on fire every single year. Now here is the part that makes this even worse. Most people finance the full purchase price of a new car. They finance the depreciation. They borrow money to lose money. They pay interest on a declining asset. Interest on top of depreciation, that is the double hit that keeps most middle-class households permanently behind. On a $45,000 car with a 72-month loan at 7.5%, which is close to the national average rate as of 2026, you pay $8,765 in interest alone over the life of the loan. So the car costs you $53,765. And it is worth less than $20,000 by the time it is paid off. The dealership finance office is one of the most sophisticated profit extraction machines ever built. And most buyers walk in completely unprepared. Here is how the financing markup works. Lenders like Ally Financial, Chase Auto, or Capital One set a buy rate, the interest rate at which they are willing to lend. The dealer then marks that rate up by 1 to 3 percentage points and pockets the difference. So if your credit qualifies you for a 5.5% buy rate, the dealer might quote you 8% and collect the spread as dealer reserve. On a $40,000 loan, the difference between 5.5% and 8% over 72 months is approximately $3,800. The dealer pockets that. You never see it itemized. It is buried in your monthly payment. The fix is simple in theory: get pre-approved financing from your own bank or credit union before you step onto a lot. Credit unions typically offer rates 1 to 2% below bank rates. When you walk in with your own financing, you transform the negotiation. Now you are a cash buyer, and the dealer cannot play games with the rate. Another tactic, the monthly payment trap. Dealers are trained to anchor your attention on the monthly payment, not the total cost. What can you afford per month? That is a question designed to extract maximum profit. A dealer can stretch a loan to 84 months, 7 years, and make an overpriced car seem affordable per month while the total cost balloons. Never negotiate a car purchase based on monthly payment. Negotiate on total out-the-door price. Then decide how to finance it. Once you agree on the car, the finance office goes to work on the back end. This is where they make a second profit on the same sale. Gap insurance. This covers the difference between what you owe on the loan and what the car is actually worth if it is totaled. Is it legitimate? Yes. But the dealership markup on gap insurance is obscene. They might charge $800 to $1,200 for a product that costs $200 to $300 if you buy it directly from your auto insurer. And your auto insurer will give you the same coverage. The dealership version is pure margin. If you need gap insurance, and with a low down payment on a depreciating car, you might buy it from your own insurance company. Not from the finance office. Extended warranties. The average dealer sold extended warranty costs $1,500 to $3,000. The actual claims paid out by warranty companies are typically 35 to 40 cents on the dollar. The rest is profit for the warranty company and commission for the finance manager who sold it to you. Consumer Reports found that most people who bought extended warranties did not use them, and those who did rarely recovered the full cost. If the car is reliable enough to buy, you should not need an extended warranty that costs thousands. If it is unreliable enough to require one, you probably should not buy it. That finance office menu: gap insurance, extended warranty, paint protection, tire and wheel coverage, key replacement, can easily add $3,000 to $5,000 to your loan balance on products that collectively deliver very little value. Now let me address the most common objection, because it is the one that sounds responsible even when it is not. I need a reliable car for work. I cannot afford to have it break down. Here is the problem with that logic: a 2-year-old certified pre-owned vehicle with 25,000 miles is reliable. A 3-year-old Toyota Camry with 35,000 miles is reliable. A 2021 Honda CR-V is reliable. These cars pass the reliability test. They do not pass the new car smell test. The reliability argument is often used to justify a $55,000 new truck when a $22,000 used truck from 2 years ago would serve the exact same function. The unreliability you are actually worried about does not become a significant factor until a car has 100,000 to 150,000 miles, and many modern vehicles do not hit the threshold until age 8 to 12. You are not buying reliability. You are paying a $20,000 to $30,000 premium for new. That premium is one of the worst purchases in personal finance. The sweet spot for used car buying is 2 to 3 years old with 25,000 to 40,000 miles. The first owner absorbed the worst depreciation. The car typically still has remaining factory warranty or is eligible for certified pre-owned warranty. Mechanically, it is functionally identical to a new car in daily use. And it costs 25 to 35% less. Here is the actual process for buying a car without getting financially destroyed. Step 1. Set your budget using total cost, not monthly payment. A reasonable rule is, the total cost of all vehicles you own should not exceed 20% of your annual gross income. If you earn $60,000 per year, your total car value should be under $12,000. That feels harsh. The math behind it is not. It protects your ability to invest the rest. Step 2. Target 2 to 3-year-old vehicles with 25,000 to 45,000 miles. Search on CarGurus, AutoTrader, and Carvana. Compare prices using Kelley Blue Book and NADA guides. Know the market value before you talk to anyone. Step 3. Get pre-approved for financing before visiting a dealership. Check your credit union first. Navy Federal, USAA, Alliant Credit Union, and local credit unions routinely beat bank rates by 1 to 2 percentage points. Step 4. Get an independent pre-purchase inspection by a mechanic you trust, not the dealer's mechanic. This costs $100 to $150 and has saved buyers thousands by catching hidden problems. Step 5. Negotiate the total out-the-door price. Include taxes, fees, and any dealer add-ons. Walk out if they push add-ons you did not request. Step 6. If you can pay cash for a car under $15,000, do it. The psychological freedom of no car payment is worth the discipline of driving a modest vehicle. Let me close with a side-by-side comparison over 10 years. Person A buys new cars every 5 years. $45,000 car, 72-month loan at 7.5%. Monthly payment, $778. Does this twice over 10 years? Total spent on cars, approximately $93,360. Car value at year 10, roughly $8,000. Net cost of transportation, $85,000. Person B buys a $15,000 used car with cash every 5 years. No loan, no interest. Sets aside the difference, about $778 per month, into an index fund at 10%. Total invested over 10 years, $93,360 in invested capital. At 10%, grows to approximately $150,000. Car cost over 10 years, $30,000 in 2 purchases. Total net worth advantage over person A at year 10, roughly $150,000 ahead. Let me say that again. The difference between buying used with cash and buying new with financing, just on one car decision repeated twice, is $150,000 in net wealth over 10 years. This is not about self-denial. This is about understanding what a car payment actually costs you when you account for what that money could do otherwise. The car is the single largest discretionary expense most people make after housing. And unlike housing, cars go down in value. Every dollar you overspend on a vehicle is a dollar that will never compound in your favor. The dealership is not your financial advisor. The finance office is not on your side. And a car payment is not a normal, expected part of adult life, it is a choice. Make it with your eyes open. Word count, 1-330 iteration, 10-minute end card. Next video, how she paid off $67,000 in debt in 26 months.